They fellow Vestels.
My son wanted to make a few videos again because he likes it, and why not do a video with him? And today I want to talk about the fully invested strategy. It has its pros and cons, and you have to see whether it fits you. And that is, of course, one part of it is lump sum versus dollar cost averaging. And here we had a great comment by Christoph Denner. Over the years I've become comfortable with crashes, although I'm almost always fully invested. So despite crashes, fully invested and comfortable. Portfolio value is not of interest to me. All that counts is the growing dividend income year over year. I still remember how nervous I got when I started investing 10 years ago and still wonder how stoic I've become since then. Every crash with its buying opportunities is a great boost to that dividend income. Also, Billy Johnson adds, Christopher, I'm in your camp. I'm always fully invested and happy to collect the dividends. I continue buying great companies when there's a stock sale. I'm not smart enough to be able to time the market. It never worked for me. And this is part and perhaps the one key for that fully invested strategy is Peter Lynch, One Up on Wall Street. He made 28% per year over the 13 years as Fidelity Magellan's when the market did 13%. And the truth is that 10 times the S&P 500 was down 10% or more, he was down way more than that. So that's something to accept when you're fully invested, especially in more, let's say, volatile assets. But on the positive side, you don't have to waste time on macro. And more importantly, with Peter Lynch, he turned $3,600 into $14 million of his wife's pension fund over 40-something years. So fully invested is not that bad. Now let's discuss what to expect when it comes to being fully invested. Of course, you have to expect ugly things happening to your portfolio. 49% down, 57% down, 34% down, and now recently 25% down. So ugly here and there is a certainty, but there is also a positive. If you just take a look at the chart here, this is 400% up. That covers up for all the negatives there. And if we look at the numbers, the statistics, from 1926 to 2011, fully invested outperforms dollar cost averaging in 67% of cases. If we check the same stats on the US, on the United Kingdom, the average numbers over such a long period of time are there. Thus, being fully invested does better, right? And then also recently, more studies have been done, but lump sum outperforms dollar cost averaging in uptrend markets, of course, while dollar cost averaging outperforms lump sum only when the asset price is mean reverted or downtrend. Well, you don't have to be a genius to make this research, but academics, nevertheless, we have to see, okay, statistically, what happens to investments. And here we have it, positive years 70, negative years 24, thus 1 year will be bad, 3 years will be good, and that is investing, and that is why fully invested usually works better than anything else. And of course, molim.
Jan, a ti si Jakub, bila sam pričaš, pa ja tebe nemoj slušati.
Dobro. The longer you invest, the lower the risk is of losing money. But over the long term, 77% should be better, and that is what comes to investing. The topic was boring for my son, so he's gone, but let's finish it calmly. He will understand the power of long-term investment over time. Now, what to expect? 77% better, but expectations, and there is also our behavior. And great comment here, he has become a stoic and he has understood that crashes are better because you can reinvest and buy more. And here we have to make a small distinction. There is dollar cost averaging when you have already the money, but there is dollar cost averaging which is likely the best strategy and one that applies to most of us, and that is, as you get your monthly income, you invest. I wouldn't call that dollar cost averaging, because it's not that the cash is waiting there. Just when you have available cash, you add it and you invest. I would just call that investing. And that is also different between investing your income versus investing just dividends. Some of you are here just dividends to invest. Some of you have income to invest and build on it, but the full invested strategy, no matter where you are, is about forgetting about the markets, forgetting about it, and then owning businesses and not stock prices. So you focus on the fundamentals of the business, and then you see where it drives you. Another great comment by M458406, the chess player here, long-time subscriber. And he says greatly, the best thing is to leave the decision whether to invest or not to your company. Most of my companies are buying back stock. Berkshire, Alphabet, Meta, Micron, Baba, Tencent, etc. Everybody's buying back stock, so even without you reinvesting, your companies are doing that for you at lower prices, thus increasing your long-term returns. Extremely important to keep in mind that you don't even have to have the cash. The companies do that for you. And then there is the benefits of dividends that is huge and extremely undervalued, I think. Even just reinvesting dividends, my friends. This is it, the S&P 500 with or without dividends. So 4,040x now without dividends. Okay, not bad over 40 something years. This is 150x with the dividends, so that is something remarkable, something extremely undervalued, because you only see the benefits, the real benefits, after year 10, 15, when that starts compounding. Year 20, you already see incredible benefits. And that's why it is underestimated, the power of this is underestimated by the population. And then my model portfolio is also fully invested now. I don't know what the market will do, but I know that if I buy a business that I like the fundamentals, where the business returns will be plus 10%, plus 15%, then my job is to buy it. If it goes down more, we just received a great dividend, reinvested that. There is also the monthly additions, and that should over time allow for good compounding and great returns. Has done good over the last 4 years, and now I'm even more excited than ever about the quality and the potential of the portfolio. So the lower it goes, actually you don't panic, you become more excited because your companies are doing buybacks, you can reinvest, and you have the monthly income that you are investing into building your wealth. That's core investing. And that's also my strategy. And you have to see when you're going to be fully invested. If you find businesses that give 10% and above, why not? And then the rest is up to the market. Have your threshold at a level that brings you to your financial goals. Some people have 6%, some 10, some 12, some 15, some 20, some even more, depending on how much effort you are putting in. That's something we're going to discuss soon with the financial goals discussion video. I hope you enjoyed this and this helps you with your investment strategy. Every investment strategy is different, but you have to see how it fits you. Thanks for watching, and I'll see you in the next video.